Okay, so we are recording. My name is Ed Estes, and I will be your instructor for this class on the new residential purchase agreement. This is going to be known as the RPA. You'll notice that previous agreements were known as the RPA-CA. This is just known as the RPA, so it's got a little shorter name to it. My day job, I teach for Mount San Antonio College. I am a full-time real estate professor here at the college, teaching principles, practice, and sometimes legal aspects of real estate. One of the reasons I like teaching to associations like yours is it gives me an opportunity to let you know about our real estate program. Not that you need to take a real estate class, but you have friends, neighbors, acquaintances thinking about getting into the real estate business. I assure you, and hopefully you agree at the end of this class, that someone is going to learn more from listening to me and my classes than they would at a home study course. At least I hope so. So let's go ahead and get into the agreement as we move through. We'll go with the first page. Let me move my screen over. And let's get into the paragraphs in page 1. So paragraph 1, of course, is the offer where we put the date we prepare this agreement. Remember, all of your deadlines go from the date of signature or the date of acceptance. The only reason we have a date prepared here is to give this contract a name. So if you're going to counter this contract, you'd be countering the contract dated whatever date, all right? Or if you were going to make an addendum, this would be an addendum to the contract dated whatever date you put there above paragraph 1. Again, we want to list all of our buyers. There is a prohibition of assignment in this contract like we had in the former RPA-CA. We'll talk about that a little bit later. We want to identify the property both by street address, city, county, and zip code. You'll notice we have an extended line for assessor parcel numbers. And the reason for that is with all this talk about ADUs and the state mandating for local authorities to allow or facilitate the subdivision of parcels, you may be listing a property with one street address, but there may be more than one actual parcel there. So they've given you a little bit more room for assessor parcel numbers. Paragraph 2 is our agency paragraph. No real big change there. If you are representing the buyer, you would put your name in that lower portion with your broker's name above, and then identify whether you are just representing the buyer or if you are in dual agency. You would also do the same with the seller's brokerage company and the individual agent that is handling that listing for the listing office. And again, put their license numbers. Remember, whatever relationship you have, your broker has, and vice versa. You and your broker have the same agency relationship, all right? If you are co-listing this property, perhaps with another agency, another brokerage, we do have a line there for paragraph C, and you would attach the CAR form ABA. We are familiar with both the agency disclosure, the AD form has to be given to the buyer as soon as possible, but definitely before you start completing this purchase agreement. When you give that AD form to the buyer, you should also give them the PRBS form. This isn't a class in agency, but my recommendation is you should disclose agency and give that PRBS form, potentially competing buyers and sellers, before you start taking the buyer out to show them property. Because at some point, you're going to want to refer to that buyer as your client, or you're going to consider that buyer your agent, or your client, or that buyer is going to consider you their agent. You cannot legally be an agent for a party until you first disclose agency. So that AD form does not create agency, but the law says you must give that AD form to your buyer before you become the agent of the buyer. So please do that sooner than later. Now we get into the dreaded paragraph 3, known also as the grid paragraph. That's what we're calling this. We're calling this the grid. And you'll notice that before we get into the grid, the last sentence or the last two sentences say, this form is 16 pages. Parties are advised to read all 16 pages. We're actually going to see that verbiage at the end of the agreement before the buyer signs it and before the seller signs it. Why? Because we know that there's a lot of people out there, they're only going to read paragraph 3. Paragraph 3 is understandable to all of us because we are in the business. We're familiar with these terms, but buyers and sellers are not, okay? If you are new to the business, you need to read the remaining 13 pages, okay? There's more to this contract than the 3 pages that paragraph 3 entails. So please do not limit your understanding of the contract to just paragraph 3. You've got to understand the entire contract. Now, having said that, I'm going to spend most of my time on paragraph 3 because the terms are put into paragraph 3. The negotiating points are all in paragraph 3, with the exception of liquidated damages and arbitration. Those are the only 2 negotiating points that are not in paragraph 3. They're much later in the contract. But everything else that's going to be negotiated is found in paragraph 3. Once we understand all the negotiating points in paragraph 3, it's going to be much easier and faster for us to move through the rest of the contract. But I will say, I promise to give you a break, a short break, but I promise to give you a break about halfway through the form, okay? So you don't have to suffer if you need to use the restroom or if you need another cup of coffee or some other beverage, okay? So let's go to paragraph 3A. Now, hopefully you can see my cursor, okay? So on the far left-hand side, we have the paragraphs of this contract. Then next to it, under the shaded heading that says paragraph number, that is a corresponding paragraph later in the agreement. The third column, okay, is the title or the term. The fourth column is detailed on terms and conditions. This is the negotiating part. And then the fifth column, if needed, is additional terms. So those are our 5 columns. Now, you'll notice that some of these spaces in the form are rather small. Here's something really tricky. If you're typing in information, let's go down to 3D2 on the right-hand side, or better yet, 3D1 on the right-hand side. If you're going to be doing something else with the deposit rather than wiring it to escrow, you may not have enough room in that little blank to put in what you're all going to do. But here's the tricky part. If you start typing information in there and you go beyond the space, a new addendum form called the TOP is going to automatically populate and be attached to this agreement. Now, this form cannot be viewed in the Zip Forms library. The only way it'll ever pop up is if you exceed the text space within the blank. Isn't that cool? Okay, so you'll be able to add additional language to these blanks because they're not long enough. It just will automatically go on this special TOP addendum form. All right. Next thing, you'll notice in that second column where it says, let's say 3A, and next to it is the number 5. Okay, so that relates to paragraph 5 later in this agreement. However, if you take your cursor and hover over it, paragraph 5 is supposed to pop up in the middle of this screen, so you'll be able to see it. Or if you click on paragraph 5, that number 5, it's going to take you to paragraph 5. Now, one or both of those should be available when this form comes out in December. Maybe not both. Hopefully by January or February, you'll have both, but CAR has been promised that one of those tools will be available when this form is released in December, maybe both of them. If not both of them, then both of them will be available within a month or so. But Zip Forms is working on having that tool. So that should be kind of neat. Now, a lot of people look at paragraph 3A and say the purchase price. Why don't you put the purchase price at the top where it's always been? Well, because the purchase price is a negotiated item, right? So what CAR wanted to do is put all your negotiated items in one spot. And then in column 4, you write out the amount. And then in column 5, whether it's an all cash or not all cash. All right. Then to paragraph 3B, close of escrow. Normally it's so many days after acceptance, right? 30 days, 45, 60 days, whatever you want to put in there. Or you can put in a specific date. I always like days after acceptance because you never know when you're actually going to get an acceptance, right? Sometimes you can get that acceptance in a day or two, but if you're dealing with a lender on an REO, lender-owned property, it could take a couple of weeks, right? So what happened to your 45-day escrow? What just turned into a 30-day escrow? So I like days after acceptance, but again, whatever you want to do, whatever your buyer wants to do. Then in paragraph 3, expiration of the offer, like the current agreement, it's 3 calendar days after buyer's signature. Or you can put in a specific date at 5 p.m. or you can change the time. Okay, lots of flexibility here. Under D2 is our initial deposit. Now remember, deposits are not required, but they're certainly expected. The consideration is the exchange of promises, since this is a bilateral agreement. But if you don't have a deposit, you're not going to be taken seriously with your seller. So I strongly recommend a deposit. I always like a maximum of $10,000. Why no more? Well, if you're over $10,000, you're out of small claims court. You got to go into superior court, which means you have to lawyer up. I will say this though, if you have a situation where you think, or maybe the listing agent is asking for a larger deposit, consider using the arbitration clause. That way, you don't necessarily have to hire an attorney. You can go into arbitration by yourself and explain to the arbitrator why you should get your deposit back without having to hire an attorney. If you want to hire an attorney, you can. But again, 10,000 is the cap for small claims. It's a lot easier to go through small claims than to lawyer up and go into superior court. Okay. But again, deposits are negotiable. Now, when you put that deposit amount in under paragraph 3D1, the contract will already state what percentage of the purchase price that deposit is. So you'll know if you're over 3% or under 3%. All right. Let's see, Ying, if you could mute your microphone, that would be great. We're getting some backup feedback from you. All right.
I muted her.
Okay, thank you. The deposit will be wired into escrow within 3 business days, and that's the only time we see business days. Oops, I went back too much. Shouldn't click on that. Everything else is going to be calendar days. So the only time we use business days is for the deposit, and it's to be wired into escrow by the buyer within 3 business days. Okay. If you want to do something else, then you check the corresponding box and you type that in. Again, I do not recommend you accept a deposit check on behalf of your buyer. I know your broker doesn't like to do that because now you're in receipt of trust funds. But if your buyer is going to deliver a check to escrow, then you could check the box there and deliver the check to escrow and just write in there, buyer to deliver a check to escrow within 3 business days. All right. D2 is if you want to do an increase of deposit. You'll notice we have a new form. Formally, when the increase of deposit comes in, if you want that increase of deposit applicable to liquidated damages, if you've included the liquidated damages clause, you would give that receipt for increase of deposit. Okay, the RID form. RID form is going away. We have a new form. It's the DID form. Okay, delivery of increase of deposit, because you're probably not going to be there when the buyer delivers that deposit to escrow. So when the buyer does deliver that increase of deposit to escrow, if you're going to include this paragraph, you need to make sure that DID form is given to the buyer immediately, so that that increase of deposit would be applicable for liquidated damages if you've included the liquidated damages clause. All right. When does that increase of deposit go in? Okay, typically upon removal of contingencies there in column 5. Removal of contingencies is anticipated to be within 17 days of acceptance. We'll see that later in paragraph 3. Dropping down to E1, the loan amount. Okay, so we put in the amount of the loan. It will automatically tell you what percentage of the purchase price the loan is. The default language, it will be a fixed rate with the buyer paying 0 points. Okay. Now, if you want to have an adjustable rate, if you want to put points in there, you can. The default language there in column 5, so it will be a conventional loan. If you're going to go with a government loan, FHA or VA, you need to check that corresponding box. Okay. And then if we drop down to the bottom of E1 in column 3, we will see that it says if FHA or VA is checked, a delivery list of lender required repairs will be done within 17 days of acceptance. So the buyer needs to inform the seller of any repairs as well as any fees or costs that the seller is expected to pay with, say, a VA loan. All right, but it's going to be done in 17 days. Dropping down to E2, okay, additional finance amount if you're going to have junior financing, a second loan or whatnot, and then clarification of that in column 5. Down to E3, we have a new addition of an occupancy type. So if you go over to paragraph 4/5, the default language is primary residence. And what do we know about primary residence? That's where you're going to get the best loan terms in terms of lower interest rates and lowest deposit. Lowest down payment. If, however, it's going to be a second home, we have a box for that. And then we have a third box for investment property. The difference here is with investment properties, it's not unusual for a lender to ask for up to 40% down. Okay, depends on the type of property. Secondary residence, you probably pay a little higher interest rate, but you still can do a down payment similar to what you have with a primary residence. Okay, well, FHA and VA may not be available for you, but with a conventional loan, you can still get PMI and work that out. So 3 different categories: primary, secondary, and investment. Just like the current form, your purchase price will show up at the bottom column, and then in F will be the balance of your down payment. All right, so it will add up for you, and the percentages will be automatically put in there so that you can use those for reference, right? All right, so let me look in the chat and see what questions we have. I think it's just Laura putting out the handouts.
But somebody directed a question to me, and I can't answer it. It's where can we type in sooner or extend ?
Where can we type in sooner or extend ?
Sooner or extend.
See, we're going to have to ask that person to send another question to me because I need more information. You don't want to use necessarily sooner. You want to have specific days. Okay, that's preferable. I mean, you can always close sooner, but it's not really a binding agreement. So you can say 60 days or sooner. That's kind of presumed, but you can't require the seller to close sooner than 60 days. So again, you need to use specific terms. I have used 60 days or sooner in agreements to let the other side know that we're willing to close sooner if it works for them, but that is not an obligation for them. You can't hold them to that. Under the contract, it would be 60 days. So hopefully that answers the question.
It did. Right? She wrote back and said you answered her question. Thank you.
Oh, you know, been doing this a lot. Sometimes I can read realtors' minds, okay? All right, so let's move on to page 2. And you'll notice page 2, the grid continues, okay? So paragraph 3G, if the seller is going to provide any credits to buyer, you can put that amount there. The default language is it will be used to offset closing costs. Of course, you can change that if you wish. Under additional finance terms, if you have any other things that you want to put in. But we'll notice in the current agreement, the most common additional finance terms was seller to pay closing costs or some closing costs for the buyer. So hopefully G1 has satisfied that. But again, CAR is trying to create an agreement to handle every situation. So you do find some extra blanks around. Then under H1, we have our verifications, H1, 2, and 3. So you'll see that they're all here and they're consistent. Under the current agreement, if you're making a cash offer, you're supposed to establish or include, attach proof of the money. However, pre-approval or pre-qualification on your loan and money for the down payment, that is to be delivered within 3 days after acceptance. So they're inconsistent. CAR has made them now consistent. So attached with this offer will be verification of all cash if it's a cash offer, verification of down payment and closing costs if there's a loan, and verification of loan application on that loan, okay? So those 3 things are to be attached with this offer. If you don't have them, then you need to check the corresponding box, which means you need to present them to the seller within 3 days. And again, calendar days. Now, under H3, on the far right-hand side, column 5, we've got some new boxes. We have pre-qualification, we have pre-approval, and we have fully underwritten pre-approval. Now, let me say first, we have not, or CAR has not, I shouldn't say we, because I'm a member of CAR like you are. I don't hold any leadership role in CAR, okay? I'm just the messenger here, okay? And Laura will attest the fact I have no leadership role in your association. But this is my definition, and CAR's definition or interpretation is the same as mine. So what does pre-qualification mean? Pre-qualification means that the buyer has actually met with the lender, okay? They've run their credit. They've gotten a verbal how much money they make, how much debt they have, how much money they have in the bank. But it's all verbal. It hasn't been verified. That's pre-qualification. We know that sometimes buyers are not as truthful as we'd like them to be. So pre-approval means all that information has been verified by the lender. They've got copies of their pay stubs and or tax returns, okay? They've looked at their bank statements. They've looked at their pay stubs, okay? They are, in addition to running their credit, okay? Based on this, they feel like this loan will go, okay? That's pre-approval. What is fully underwritten pre-approval? Well, this is pretty much approved, okay? The underwriter has gone through the entire analysis and has said, this loan is good, this loan has or can be funded. The only thing we're missing is the appraisal. Okay, so the only thing we're missing here is the appraisal. That's what fully underwritten pre-approval means. So why do we have that? Why not just stay with pre-approval? Because CAR wants to give buyers who need financing the same playing field as an all-cash buyer. So you're going against an all-cash buyer, right? Your buyer needs a loan, but they have fully underwritten pre-approval. That means they can get the loan if the property appraises. Okay. Well, you might say, well, what about the buyer paying all cash? Well, the buyer paying all cash has got an appraisal contingency as well. They can walk away. But in terms of being able to afford and purchase the property, they're both in the same position. So hopefully this will put you in a stronger position with your buyer who needs to get financing with a competing buyer who may be all cash, right? So that is fully underwritten pre-approval. Now you'll notice that I is left blank. The reason for that is 3I looks a lot like 31. When we get down to 3O, we'll see that that's left blank as well, because 3O looks a lot like 30. O and 0, I and 1. So they've just left them blank, so there's less chance of confusion. And then J and K, J, final verification of condition. That will again be 5 days prior to close of escrow, our walkthrough. And then K, assignment request. So we'll get to paragraph 23 a little bit later, where the assignment request is explained, and I can field some more questions then. Let me explain what K means and paragraph 23 means. Okay, so buyers buying the property and they want to be able to assign. Well, who are they going to assign to? Well, if they are assigning to their living trust, an LLC, a corporation, which they are the owner. In other words, we call that in legal circles an alter ego. They're assigning it essentially to themselves, just in a different name. It's their living trust. Okay, seller cannot prohibit that assignment. That assignment is not prohibited. However, if they're going to be assigning to a third party, they need to get the seller's permission. Seller's permission will not be unreasonably denied. However, they must make a request to seller for that assignment within 17 days. Okay. If they wait till after 17 days, seller's under no obligation to approve the assignment. The assignment has been deemed inappropriate. Now, if the seller still wants to, they can, but they don't have to. But during the first 17 days, seller may not unreasonably deny the assignment. Moreover, if the buyer is assigning and accepting money from the person receiving the assignment, that has to be disclosed to the seller. This term, what we call warehousing, where you put a property in escrow and then you try to assign your right to somebody else for money, that all has to be disclosed to the seller, and the seller does not have to approve if they think that you're unjustly enriching yourself. Okay, so anyway, that's how the assignment works. We'll cover that a little bit more when we get into paragraph 23, and you can see where it's all laid out what I just verbally gave you. All right, let's move on.
You have a few questions you want to.
Okay, let me go back and attack those. And okay, may we have access to the recording? Absolutely, Bill. I understand Laura is going to post this on the association website. Laura, yes. You can probably tell them when that's going to occur, but within a few days, right?
Yeah.
Okay, so it'll be there. Why would a seller not want to sign the assignment request? Okay, so Virginia, I make an offer on your property, and let's say I'm offering, I don't know, 600,000, and you agree. And now I want to do an assignment. You find out from the assignment that somebody's paying me $75,000 for that assignment. So what have you done? you've underpriced the property, haven't you? You're a little upset. You're saying, wait a minute, I sold this property to, what did I say, Laura, 600,000? And really the property's worth 675. Time out here. This doesn't seem right. That's where a seller may object to assignment. So I think that's what CAR is trying to do. They're trying to stop these, double-ended escrow things, okay? That's my opinion, all right? Let's see. Can you enter the trust name on the buyer section instead of individual names? Absolutely, if the trust can afford to buy it. But typically trusts don't have income. The beneficiaries of the trust who have jobs have the income. So how does it work? The buyer is buying the property and qualifying for the loan, but then they're going to assign it to the trust. And the ability to assign it to the trust kind of depends on the lender. Sometimes that assignment doesn't occur until at closing, right? Because the lender wants the buyer on the deed of trust and the promissory note, and then the trust comes into play. So sometimes it's just a loan qualifying thing. Yeah, if the trust has assets and can afford to buy the property, but most people's living trusts don't have income. Some do, right? Some do, but most don't, right? The income comes from your job. That's what you're qualifying for. So the lender is making the approval on the individual. It's just that they're going to transfer into the trust for estate planning purposes down the road. Okay, trying to get some flexibility here. Just trying to get some flexibility here. Can the seller ask proof that the LLC or the trust is related to the buyer? Yes, I think they can. I think they can. If the buyer wishes to assign and it's not obvious that this LLC or this trust is them. For example, my dad's trust is the Estes 1999 Family Trust. Well, I don't think you want to ask proof for that. I mean, it's obvious their name is in there. It's their trust, right? But if it's, and we've got an LLC, the Estes Family LLC, okay, that's pretty obvious. But if my trust is the Gabba Gabba Goo Goo Trust, who is that? Yes, okay, yes, they can, okay? Because again, they're trying to do is prevent this double ending of deals, right? Which may be taking advantage of the seller. That's what they're worried about. All right, I think I've got everything here. I'm going to try something here. You may wonder what those X's mean. That means I've answered the questions to that point. So now when I scroll back for more questions, I know where to not go further back. Okay, so that's going to be I'm just trying it with this webinar. I'm going to see how it works. If you'd rather use me, you may have me use a different letter. I'm happy to do that. Okay, so let's move ahead, and we're into paragraph L. And this is where we're talking about the loan now and other contingencies. Now, I like this paragraph. You'll notice that L is going to relate to paragraph 8 later on, but I'm going to spend most of my time here talking about paragraph 3L, and that will speed us up when we get later in the contract. So the loan, time to remove the contingency, 17 days. Currently, it's 21 days, right? And of course, the problem there is you need to give a notice to perform on the inspection contingencies on or before the 17th day. Actually, you can do it 2 days early, so the 15th, 16th, or 17th day. But you have to wait on the loan contingency until the 19th, 20th, or 21st day, because you can give that notice to perform 2 days early, right? Well, they've made it consistent. Notice in column 4, everything is now 17 days. So it made it nice and consistent. Should make it easier for you to navigate through your transaction, all right? So both the loan contingency and the appraisal contingency can be removed with this offer. So we go to column 5. we see that the loan contingency, appraisal contingency can be removed. But note, you cannot remove an appraisal contingency on an FHA or a VA loan. Well, I guess you can, but the buyer still has cancellation rights. If the property doesn't appraise on an FHA or VA loan, then the buyer can cancel. So you can't really remove that. Well, you could remove the contingency, but it doesn't do any good because the buyer always has cancellation rights with an FHA or a VA. So just FYI on that, all right? The loan contingency, the appraisal contingency are independent of each other. So what is the loan contingency? Essentially, the buyer's credit or the buyer's income is not sufficient for them to get a loan. That's the loan contingency. What's the appraisal contingency? The property is not worth what is being offered for it. That's the appraisal contingency. Well, what about the buyer can't get insurance because the seller has made too many claims against the property and the buyer can't get hazard insurance and they can't get a loan without hazard insurance? Is that the loan contingency? No. Is that the appraisal contingency? No, that's the investigation of property contingency, because you're supposed to investigate the ability to get insurance on the property. So it's very important that you use the contingencies in the way they were created, all right? So don't go releasing contingencies unless you know what the contingencies are and what they do, all right? Don't confuse them. I get agents talking to me all the time and say, oh, no, it's no problem because we still have our loan contingency. The loan contingency is for credit and income and capital, okay? The appraisal contingency is the value of the property. The investigation contingencies is other stuff like getting finance or getting insurance and that sort of thing, all right? Now notice, not a contingency, but a covenant in the contract is seller is agreeing to give informational access to the property, okay? So the buyer, even if they waive all their contingencies, the buyer still has the right to investigate and go inside and look around, okay? They may not have a reason to cancel, but they can still investigate. Now, for the contingencies listed in L3, 4, 5, 6, and 7, if you want to release any or all of those, then over on column 5, you need to attach the contingency removal form, the CR form, all right? Those contingencies cannot be released with the offer, right? Review of seller documents, preliminary title report, common interest disclosures, review of leased and leased items. And it even goes into, these are those PACE loans or hero loans, which act as a super lien, right? For people to put in solar panels, double pane windows, add additional insulation, so on. Okay, so those may be a separate lien on the property, and the buyer needs to verify whether there's enough equity to pay those off if they can't be assumed, or whether the buyer does want to assume them if they're even assumable, right? So again, since we don't know what's going on that property till we actually get into escrow and look at those liens or leases, again, buyer has 17 days to investigate that. And then finally, L8, if the sale of this property is contingent on buyer selling their other home, you would attach that COP form, all right? Now, with these contingencies, remember, and I'll talk about this later in the agreement, I just want to make sure I cover it right now. If you release all your contingencies, so loan, appraisal, all the other contingency with a contingency removal form, does the buyer have to now buy the property or be in breach if they don't? Not necessarily, because in most transactions, sellers are required to give what? A transfer disclosure statement, a natural hazard disclosure. maybe that fire hardening defensible space disclosure, lead-based paint disclosure. All of those carry cancellation rights. So let's talk about the TDS, because that's what we're most familiar with. Upon receipt of the TDS personally, 3 days. If it's mailed, either through the post office or email, 5 days, buyer can cancel. But they removed all their contingencies. It doesn't matter. You cannot remove by contract a statutory right that the legislature has given you. And because the transfer disclosure statement is required under Civil Code 1102, that cannot be waived. So the buyer will always have that right to cancel upon receipt of the TDS, and they don't even have to give a reason. Assuming the seller has to give a TDS, but we know that there's a lot of sellers out there that don't have to give a TDS. So you need to be very careful when you're talking to your buyers about releasing contingencies, or sellers about the releasing of contingencies, that you don't misrepresent. Okay, the only thing you're releasing here, if you release contingencies early, are loan, appraisal, investigation, review of documents, title, common interest disclosures, lease or lien items. That's all you're releasing. Okay, you're not waiving your right to those statutory disclosures, if they're even applicable, but sometimes they're not. So you have to be careful about that. Okay, we got stuff loading up in the chat. So let me go back here and see if I found my X's. If the seller disclosure insurance claims, if the seller discloses insurance claims, there is no fault of the buyer if buyer cannot get insurance, right? If they haven't released their investigation of the property contingency. But if they've released all their contingencies, including the investigation of property, and then the buyer can't get insurance, the buyer may be in breach of the agreement, could be sued for damages, or forfeit their deposit if liquidated damages applies. Okay, so you need to be careful there. Seller is supposed to disclose insurance claims if they know about them, if they remember them during the first 7 days. Buyer still needs to investigate. Now, if the seller gives a late disclosure, okay, so let's look back here on time to remove contingencies. It's 17 days after acceptance or 5 days after receipt, whichever is later. So if the seller gives a late disclosure, let's say they give a disclosure on the 15th, then the buyer's going to have until the 20th to release their contingency on that particular disclosure, because it's 17 days from acceptance or 5 days after receipt, whichever is later. If the seller gives the disclosure on the 10th, the 5 days would be the 15th. So the 17 days is later. So it's whichever is later, 17 days from the acceptance or 5 days after receipt, okay, whichever is the latest date. So you just kind of have to watch when it comes in. All right, so where am I? Okay, so got Jose. Betty says, what about contingent upon seller finding a replacement home? Okay, that would typically be included as a counter offer, or you would attach it in other terms later in this agreement. Okay, I think it's paragraph R, and you would then make it contingent on seller finding a replacement home, and you would add that seller contingency form. It starts with an S. I always forget the name of it, but CAR does have a form to allow the seller, and the default language is 17 days to find a replacement property. You would either attach it as an addendum to this form. You could also do it in paragraph 4 with the advisories and addenda. You could include it there. That might be a better place to include it. Or it might come back as a seller counter. It might be part of a seller counter, because it may not be noted in the MLS that seller is selling this property contingency and finding a replacement home. So when the agent and the buyer write this offer, they wouldn't know about it. All right. Virginia asked, if the SHA buyer wants to pay the difference in the appraised value, should the value come in lower, where would that verbiage go? My recommendation is don't put it in here, because I'm not sure it's enforceable, because I think the verbiage in that FHA amendatory clause, that FVAC, would effectively prohibit it, okay? Buyer is still going to have cancellation rights on that appraisal, okay? That's my understanding. It's federal law. So you cannot contract around law, okay? You cannot contract around 1102 with the TDS. You can't contract around what Congress has established as protections with FHA and VA. So it's going to have to be done in escrow, essentially, on or before the 17th day. At what point is the earnest money deposit at risk for a loss? Rule number one, you have to include the liquidated damages clause. Okay. Rule number two, the buyer has to release their contingencies. Rule number three, buyer doesn't perform. So each one of those steps has to take place. Liquidated damages clause is included, okay, initialed by both parties. We'll get to that, okay. Second, buyer has released all their contingencies in writing per the contract. And third, buyer breaches, buyer fails to perform, okay. If all three of those are present, then the seller can make claim to the deposit as liquidated damages, all right. A copy of the EMD check is considered as actual EMD check, such as record into the broker's trust account. You don't want a copy of the check, because if you have a copy of the check, that means you touched the check. And if you touch the check, arguably you're in receipt of trust funds. So you want the buyer to wire or electronically transfer that money into escrow. That's how the contract is set up, okay? If the buyer is terrified of electronic transfer of funds, then up above, you would just check that box and say, buyer to deliver personal check to escrow within 3 business days of acceptance. To make it very clear what's happening. I know there are some agents out there that still want to see a copy of the check, those agents representing the sellers. They are dinosaurs. That provision of having the buyer give a check to escrow, that's like 10, 15 years ago. That language has been struck from this agreement 5, 10, 15 years ago. We don't do it that way anymore because it creates liability for you having to take receipt of trust funds. So if you do run into a listing agent or a seller's agent who's insisting about it, and you want me to call them up and tell them they're a dinosaur, troglodyte, a fossil, I'm happy to do so, okay? You don't want to do that. It's creating liability for everybody, and CAR is trying to eliminate that liability, so please don't. How a buyer investigates if there have been insurance claims. You can get one of those clue reports, but that's going to cost a little money. The best way is just contact the buyer's insurance agent and say, look, I'm thinking about buying this property. Here's the address. Any problems in writing a policy on this property? They go into their database and they can actually look up a claims history. It's kind of like auto insurance. If you get canceled by your auto insurance company because you're a bad driver and you go to a different company, you're going to have problems with them too because they can see your driving record, right? Well, the same thing with property insurance. Property insurance agents can see the claim record on properties. So they can tell you for free if there's any issues from past claims on the property, all right? Is it true that a TDS is not required for a house that was previously acquired in a foreclosure and the seller never occupied the property? No, that is not true. The only one that's exempt in that scenario is the lender who is selling it to the now seller. The lender does not have to give a TDS if they acquired the property through foreclosure or a deed in lieu of foreclosure. But the seller who bought that property, which we call an REO, real estate owned, who is now going to sell it, they are required to give a TDS, whether they lived in it or did not live in it. Okay, hopefully that clears it up. SPRP, that I assume, Teresa, is educating me the name of the form that allows the seller to exert a contingency to find a replacement property. Okay, thank you, Teresa. See, that's a problem, Laura. When I do this class, I don't have. I need to get one of your associations I do classes to buy me one of those darn forms books so I can look these things up so I'll appear smarter than I am. Can we do a Q&A at the end? Of course. I'm not going anywhere, okay? I've got to be on campus for another 2 hours. I've got office hours. I'm actually here. My office is just above my head right up there. Laura's been here. Okay, if the seller has a claim for home insurance, how many years this claim does the seller need to disclose? I believe the SPQ, Seller Property Questionnaire, calls out 5 years, okay? So I would use that as my tool. You'll be using the Seller Property Questionnaire or SPQ. The question in there asks the seller if any claims been, I believe it's 5 years. So use the 5 years. Will this last 5 years? Will this last 5 hours? No, 3 hours. 3 hours is what I'm going for, and I'm going to be moving. Okay, can the buyer still cancel if the loan is not approved due to low appraisal and the buyer removed the appraisal? No. If the buyer releases the appraisal contingency and the property doesn't appraise, the buyer cannot cancel based on the appraisal. Can they cancel on the loan? Only if it's their credit, their income, or how much money they have in the bank. Okay? Because the loan contingency is on their ability to repay the loan. The appraisal contingency is on the property's value being at the contract price. Okay, so I made it through. Moving on. Promise to give you a break in about 30 minutes. Okay. Now we get into paragraph M, dealing with possession. So time of possession will be upon notice of recordation. Okay. Or if you want an extension about that, we'll talk about the TOPA in M3. Right. Or you can make it at 6 p.m. on the date of recordation, or you can make it a different time, okay? So it's however you want to give it to them. Now, if you have a situation where the seller is going to stay in the property after close of escrow, so we call this COE plus. The most common one is what? COE plus 3, right? We're going to give the seller 3 additional days. Why would I do that? Well, if you're writing an offer on a property and you've got an elderly seller, at that point, when they're in their 80s, it's not the money anymore. It's convenience. And a lot of sellers will discount the sale of their property if you facilitate it, make it easy for them to move out. Giving them a little extra time can do that. I'm really not worried about the seller in their 80s trashing the house, right? Just make sure that your insurance company and your lender know about this, right? They need to know because you may need a rider on your insurance policy. Going down to M2, if the seller is going to remain for 29 days or less, we use the SIP form. If the seller is going to remain in the property over 30 days or longer, we're going to use the RLAS form. That's on the column 5 there. What's the difference? Well, if the seller's just there for 2 or 3 days, it's not really a big deal, right? Well, just taking them a little longer to move out. So what? But if the seller's in there for over a month, now you may need to address things like rent, security deposit, other stuff, right? And that could cause problems with your loan, could also cause problems with your insurance, because now it's truly an investment property. 29 days or less, we can argue whether it's, an investment. But if it's over 30 days, looks a lot like a true landlord-tenant situation, even though less than 30 days is really landlord-tenant situation too, but there's a different dynamic. So it's spelled out. Now, M3, this is a big one, okay? Tenant-occupied units. Now, if you've got a property with a tenant in there that you're buying, you need to check this box, and then the TOPA is supposed to attach. What's the TOPA? Well, the TOPA says that the tenant will remain unless you check the box. If you check the box in the first paragraph of the TOPA, it says that the tenant will be out of the property 5 days prior to close. Why 5 days? Because that's when you're going to do your final walkthrough, your verification of condition. And you want to go through there and make sure the tenant's not there, right? But what if the tenant doesn't move out? What does the TOPA say? Well, the TOPA says that if the seller agrees to get the tenant out 5 days prior to close, but the seller doesn't, then the buyer has a choice. The buyer can either buy the property with the tenant, which I don't recommend if the buyer intends to occupy the property as their personal residence, or the buyer can cancel, get their deposit back, cost of their appraisal back, and cost of their inspection back. But that's it. Can the buyer sue the seller for breach? No. And the TOPA goes on to say the buyer is waiving all other claims they may have against the seller. Now, some of you are saying, well, my buyer's not going to like that at all. Well, CAR made a judgment call here. CAR acknowledged that it is difficult to get tenants out of properties, even though on most rent control ordinances, a valid claim to get a tenant out is going out of business, which is what the seller is doing, selling the property, or occupancy by the owner, which is what the buyer is going to be doing when they buy the property. It's still hard to get tenants out. So CAR came on the side of the seller here, not on the buyer, and that's how that TOP is worded. I've looked at it to try to say, is there anything I can tell you here about tweaking it? And the answer is no. There's nothing I can give you to tweak it. Can you hire an attorney to fix? Yes, you can. You can hire an attorney to create an addendum to go against what the TOPA is doing. But that's what you need to do. If you don't like what's in the TOPA and you want to change it, if you don't like what I just said, then hire an attorney. And don't call me, because I just teach the forms. I don't actually practice law anymore. All right, so N is documents, fees, and compliance. So the seller will deliver all documents to the buyer within 7 days. The parties will sign escrow instructions within 5 days of receipt. The seller will order their HOA documents, if applicable, within 3 days after acceptance. And the seller is going to install a smoke alarm, carbon monoxide detector, and water heater bracing within 7 days after acceptance. Now, who's going to pay for that will be negotiated in a later paragraph. But the seller needs to install it, all right? So you can have the buyer pay for the installation and pay for the devices, but the seller still needs to install it within 7 days. Why? Because the appraiser is going to be out there within 7 days or 10 days or whenever the appraiser comes out there. And of course, the appraiser is looking for those things, right? And if they're not there, then the appraiser is going to have a missing component. The appraiser is going to have to come back, and there's usually a charge for that. And the contract actually says that the seller will have to pay that charge. Why? Because the seller was supposed to have those things installed within 7 days. Actually, they're supposed to be installed anyway. State law requires houses to have smoke alarms, CO detectors, and water heater bracing. And if you don't have those in your home, you're in violation of the law. Of course, I think it's only a $100 fine, so nobody cares. Well, you should care, because if you get a fire, you have a CO2 emission, it can be bad, right? So the seller needs to have those installed within 7 days. So those of you taking listings, when you do your visual inspection of the property, if you don't see a smoke alarm, if you don't see a CO2 detector, if the water heater is not braced, you need to tell the seller, hey, seller, you need to do these things, okay? The law requires it. Contract, the offer is going to ask you to do it within 7 days. Please do it now. It'll make our transaction a lot smoother. All right, so let me go back into the chat. Is the SIP required, or is it a suggestion? If the tenant is, if the seller is going to stay in the property for up to 29 days after close of escrow, then the contract requires an SIP, okay? Could you modify the contract and remove that? Yes, but you're acting on your own risk. Please don't do that. You know, CAR created these forms basically to protect realtors. If you start deleting things or don't follow the form, make sure you're doing it on the advice of an attorney, okay? Because you're probably going to get in trouble if you're not careful. Let's see. Is the TDS only a seller disclosure with statutory cancellation price for the buyer, or does the SPQ also have a clause? Okay, so the TDS has a cancellation by statute. The SPQ is in the contract. So the contract requires the SPQ, okay? Unless the seller is exempt from a TDS, then the contract requires the ESD, okay? Can the ESD or the SPQ be removed by a counteroffer or an addendum? Yes, it can. However, both of those documents ask for information. Now, if I'm representing a lender on an REO sale, in other words, this is a property that was foreclosed upon, I have the listing from the lender, I will probably talk to the lender to see if they are willing to do an ESD. Most lenders are not. Same thing with bankruptcies, many probates, conservatorships, guardianships. Can you counter out the ESD? Yes, you can if it's instructions from your seller, right? What if you have an investor seller who doesn't want to do an SPQ? Can they counter it out? Yes, they can. But the first page of that SPQ is asking about material facts. The seller still has to disclose all material facts. So be very careful about countering things out. Seller still has the obligation of disclosing, all right? Can you explain the TOPA regarding tenants again? Okay, so what the TOPA says, and it needs to be included if you have a tenant-occupied property that the buyer is purchasing, okay? The TOPA says the tenant can remain. If you want the tenant out, you check the box in the top paragraph, and that then says the seller will have the tenant out 5 days prior to close. However, if tenant doesn't move out, then the buyer can either buy the property and get the tenant, waiving all claims against the seller, or the buyer can cancel, get their deposit back, get their inspection fees back, and get their appraisal fees back. Even if they've released their contingencies, they still get those back. but they can't sue the seller for any other out-of-pocket expenses that they may have suffered. Okay. For those of you who are really excited about that TOPA, email me after class. I can send you a copy of it. Okay. Why don't I go through all these forms with you? Because CAR changed 63 forms in this contract. Do you realize there are 80 forms referenced in this contract? And it's not this contract. CAR changed another 4 or 5 other purchase agreements, like the residential income, commercial property, vacant land, notice of default purchase agreement. Everything got changed to this grid pattern. Okay. Let's see. Column 5, L4 says removal waiver at time of offer is against agent advice. If some are waived at the time of offer, can buyer's agent be liable later? Well, the reason CAR puts that language in there, and I think you'll all agree with me, if you're releasing contingencies with the offer, you're putting yourself in harm's way. So the reason the language is in here is to make it clear that if the buyer chooses to release contingencies early, then they're doing it on their own and not on the recommendation of the agent. Okay, so hopefully that will protect the agent if the buyer comes back and says, hey, you should have told me not to release my contingencies. The agent come back and says, not only did I tell you, it's in your offer, right? Escrow instructions are not filled out by the buyer during the time frame. Can sellers cancel? Seller needs to give a notice to perform to buyer. And remember, it's a 2-day notice to perform if buyer doesn't return escrow instructions. After they give that notice to perform, wait the 2 days, then boom, yes, they can cancel, all right? Is the TOP replacing the TIP? Kind of, sort of, okay? But it's also replacing language that's in the current agreement, because the current agreement says that the seller will have the tenant removed 5 days prior to close. So it's actually doing both, kind of, okay? All right, so moving on. Oops. There we go. Got my X's in there. All right. I think we're done with this one. Great. Moving quickly into page 3. Okay. So items included or excluded. Okay. This is a negotiable item. The only thing that's, I guess, not negotiable are those bathroom mirrors. That has been pre-checked. Bathroom mirrors have to stay in the house. Look for some other stuff. Notice in the center column at the bottom, wall-mounted brackets for video or audio equipment. The current contract says that the TV can be removed, but the bracket stays. If you check the box in the current agreement, you can remove the bracket, patch the holes, but you don't have to repaint. This agreement says the seller can remove the TV and the bracket. And in paragraph 9, you'll see they still have to patch the holes, but they don't have to paint. Okay, so it's a change between the 2 agreements. Pretty much everything is here. Just as a practice note, I always like to check stove. I don't want the seller removing the stove. I know we get into this real property, personal property argument. I have had these arguments with members of the Standard Forms Committee, and I've just given up because they want to lecture me on the difference of real property and personal property. I spent a whole month suffering through that with my real property professor in law school. I don't want to hear it from somebody from the Standard Forms Committee, but make it easy on yourself. Just always check stove so that there's no question that the stove is remaining in the property. And then whichever other items the buyer wants, okay? If you understand that the seller wants to remove some items, perhaps it's in the confidential remarks in the MLS, you can put that down in P2, all right? Now we get into allocation of costs. big sub-paragraph, but it moves pretty fast. Okay, so going over, I'm sorry, try to convert yourself to the chat and please mute yourself, Paul. I would appreciate it. Okay, so our first item description, NHD, okay, who's going to pay for that? Typically the seller does, right? Then we have two more spaces, Q2, Q3, for any other reports. Okay. Q4, smoke alarms, CO2 detectors, and water heater bracing. Remember, the seller has to install them. Here is where you can negotiate who's going to pay for those items. Okay. Governmental required point of sale inspections report if you're in that jurisdiction. Any corrective action required from local governments. Typically, what comes up are homes with low flow or do not have low flow water conservation. So if the house was built before 1994, the law did not require low flow water conservation fixtures. If the property was built after 94, the law did require it. So unless the seller made any changes, you should be okay. Okay, but 1994 was the definitive year. All right. Escrow fees. Okay, so we have buyer, seller, or both. And if you check both, it's going to be split equally. That's what it says at the top in the shaded area. So escrow fees. We have buyer, seller, both, each to pay their own. Well, what does that mean? Well, I'm sure this was quite a discussion item at the Standard Forms Committee meeting. Here's what I think happened, okay? Agents obviously often just say both 50-50, right? But you really don't mean both 50-50 because in a transaction, there's typically two escrows. You have the sale escrow between the seller and the buyer, but you also have a loan escrow between the buyer borrower and the lender, right? You actually have two escrows going on. So the term each to pay their own is interpreted as the buyer and seller will split equally the escrow cost of the sale, but the buyer is going to be paying any escrow charges for their loan escrow, okay? That's my interpretation. I think most people will agree with me on that. We're moving on, all right? Title insurance, buyer's lender title policy. Well, again, that's part of the buyer's loan obligation. So that's not negotiable here. That's just for the buyer. And then transfer taxes, city transfer taxes, that's negotiable. HOA fee for preparing disclosures. So since the seller's required by statute to make the disclosures, the contract says the seller will pay the fees for the HOA to prepare those disclosures, like the CC&Rs. But the HOA certification fee, this is a fee that the HOA may charge because the lender wants a certification. Maybe what is the reserves? Or maybe there's something else going on at the HOA that the percentage of owner occupants and rented occupants, right? Sometimes lenders want that information. They're asking the HOA to certify something. Well, that's going to be a buyer expense because it's something required from the buyer's lender. HOA transfer fees can be negotiated. Typically, seller pays those. Likewise, private transfer fees. Some developments in rural areas may have a private transfer fee because it was required because of an environmental lawsuit that was involved, all right? And any other fees or costs, Q16, Q17, and then the home warranty plan. Again, rather than checking a buyer box, I recommend leaving it blank because if you check a buyer box, and sometimes the lender will add it as a loan condition. So if the buyer's not going to ask the seller to pay for a home warranty plan, but they don't want to commit to paying for one, then check the box that says buyer waives a home warranty plan. When we get to paragraph 10C, you'll see that the buyer can always agree to buy a home warranty plan if they want to. But that way, the lender won't require it as a loan condition. All right. So then in the fifth column, we can identify the escrow holder, the title company if it's different from the escrow holder. Okay. And we can put a cap on the home warranty plan if we're asking the seller to pay for it. All right. Don't see anything in the chat, so I must have done a good job. R is our other terms. And now I'm going to real quickly take the top part of page 4, and then I'm going to give you guys a real short break. Okay, so remember we're talking about adding addenda, changing things, that sort of thing. Okay, so paragraph 4A, any other addenda? All right, so we can put those here. If you're writing that offer and you know the seller needs a certain amount of time to find a new place, you can add that to B, other addenda. Okay, just check that box and add that form. Couple things under 4A, we've got some new forms coming out. Okay, we've got the tenancy in common purchase agreement, the TIC PA, or purchase addendum, and we have the stock cooperative purchase agreement addendum. Okay, so all of these addendums, probate, manufactured home, CAR used to have a probate purchase agreement. They used to have a manufactured home purchase agreement, but to try to keep things more simple, they said, you know, those agreements were pretty much the same as the purchase agreement. Why don't we just have one purchase agreement to purchase a single family dwelling? And if it's a probate or a manufactured home, we'll just have an addendum to cover those additional items. What's a TIC, tenant in common purchase? Okay, not so much here, but particularly up in San Francisco, where things are really crazy. You may have 4 people purchasing a fourplex, and each one of them is going to occupy a different apartment. Right? So they're going to own it as tenants in common. And in their tenant in common agreement, they're going to have exclusive use to one of the units. It's not a subdivision. Okay, they all own it together, and you're buying one person's 25% interest that allows you to occupy that particular apartment or unit. What do you got? It's kind of messy. So CAR has come up with this tenant in common purchase addendum to deal with that. Likewise, if you're buying into a stock cooperative, again, stock cooperative is not a subdivision. There is one deed on the whole property, but the property is owned by a corporation, and you're buying a share of stock that allows you to occupy one of the apartments or units in that complex. See, it's not like a condo or a planned development where you're getting a deed. In the TIC and the co-op, with the TIC, you're getting a deed, but for only a percentage interest in the whole. It's not a separate ownership. So CAR is working with DRE, because DRE is the one that approves subdivisions and quasi-subdivisions. And I like to call TICs, tenant in commons, and stock cooperatives as these quasi subdivisions. So these 2 forms are supposed to help you with that. Okay. Like I said, if you are just fascinated with that and you want to see a copy of it early, shoot me an email. I'll send it to you. Okay. But I don't think you have to worry about it down here. Maybe in downtown Los Angeles, maybe in Santa Monica, but not here. Okay. Not here, fortunately. Okay, so again, our other addendums here. Notice under C, wildfire disaster advisory, the WDFA, that is not a required form. Okay, not a required form. You will use that form if you are involved in a transaction where you have a potential fire hazard, like up in the foothills, okay, of the San Gabriel Mountains. You may want to include that. Do not confuse that with the fire hardening defensible space. That is a required form. We'll talk about that later in this agreement, okay? I don't recommend the fire hardening defensible space form unless it's required because it confuses the heck out of everybody. I think you can get to where you want to be with the wildfire disaster advisory, okay? That's just my opinion as a teacher, not as a lawyer, all right? Well, golly, we've been at this for about 90 minutes. I'm going to set my timer for 5 minutes on my phone. You should all do the same. And that way, when we come back, we'll be ready to go. All right. So I'm starting my 5-minute timer. Now's the time to take your restroom break, get another beverage. Just let your screen go up. Mute yourself if you might have a partially clothed person running around because this is being recorded. I recommend we keep the recording on so when it's replayed, those people who are watching the replay know they can go potty too. I'm going to see you in 4 minutes and 35 seconds. Okay, we're going to get started in just a few more seconds. Our 5 minutes is up, but I know you're racing back with your coffee, tea, or whatever. Recording in progress. All righty, so we're back. Let's go into the chat and see what questions we have. Oops. Sorry about that. Let's see. So Monica wants to know, where can we put the buyer's agent to pay for home warranty? Let's go back to the grid. Go down to 3Q18, buyer's home warranty. Go to column, go to column 4. You just simply check the seller box there. All right. So the buyer pays for it, seller pays for it, both pay for it. Or typically what we're probably going to see is buyer waives the home warranty plan. But when we go back to paragraph 10C, they can always decide to buy it later if they want to pay for it. They can't require the seller to pay for it. I guess you could put for a request for repairs for seller to pay for it. All right. Moving on into our addendum. Let's see. What else do we have in the chat? So we don't have a probate purchase agreement anymore. We just have the probate addendum, manufactured home addendum, TIC addendum, stock cooperative addendum. All right. Let's see. Can the property be a rental property even though they only own 25% of their share? Okay, so again, Joey, I probably need a little bit more information to accurately answer your question. If you're talking about buying into a tenant in common situation and you are buying a fractional share and you're going to be then allowed to occupy one of those units, could you then rent that one unit out? Presumably, if it doesn't violate something in the agreement, I'm assuming the tenant in common ownership would have some sort of operating or ownership agreement that everybody has to abide by. I honestly have never seen such an animal. This is kind of new to me. I never practiced in a high density area where I come across it, but it's kind of a new animal anyway. I mean, this is something basically because housing is just so expensive. All right. All right. So I think we've now completed. I meant, where do we put that the agent for the buyer will pay the home warranty? Oh, okay. So go back to Q. Good question. You could put that in other terms if you wanted to. You could have a separate agreement with just your buyer that you're going to pay for it. You wouldn't have to be part of the contract. And I would recommend not putting it in the contract since you're not a party to the contract. So it wouldn't be enforceable against you. So you would want to have a separate agreement with the buyer. You could do it as either an addendum to or in other terms of the buyer representation agreement, or just some other document between you and the buyer. But it would be signed between you / your broker and the buyer. Talk to your broker about that. But again, you wouldn't want to put it in the purchase agreement because it doesn't obligate you because you're not a party to the purchase agreement. Only the buyer and seller are. All right. Another question coming in the chat. Okay, thanks. Okay, good. So now we get to move on. And we are going to be picking up the pace just a little bit. Okay, just pick up the pace a little bit because you've pretty much learned everything new about this agreement. All right. But moving on, paragraph 5, This is where we talk about the purchase price, the deposit, increase the deposit, and retention of deposit. So under 5A3, remember, there is no such thing as a non-refundable deposit in single-family residential purchases. And you might say, well, wait a minute, I've put that into a contract before. Well, the only thing worse than the unlicensed practice of law is the unlicensed practice of the wrong law, which is what you're doing if you're out there writing non-refundable deposit in single-family residential purchases. So please don't do that. A liquidated damages is different. And this paragraph specifically says, please don't say deposits are forfeitures or non-refundable. Don't go there, okay? Just leave the documentation as it is. B gives more explanation to an all-cash offer. And C goes into the loan. Now, in dealing with the loan, drop down to C4, FHA and VA. Something you're going to see new, remember with the FHA in the current contract, they have the FVA form. That's the form that the buyer uses to request the seller to make repairs or pay costs in the case of a VA loan. That was really kind of a request for repairs form, wasn't it? So the new request for repairs, yes, you're getting a new request for repairs in December. Like I said, we're going to see probably 63 forms being changed. So Laura, no, I am not going to do a new forms class because it would take me days to get through all those forms. But we might do something, kind of an overview. But we're going to now use the request for repairs to ask the seller to pay for any FHA, VA work, and any VA expenses. Okay, and then the request for repairs form is being modified to allow for that. So there's going to be a new little paragraph in the request for repairs form, the RR form, to address FHA, VA mandates or requirements. All right. D explains the balance of the purchase price, and then E limits on credits to buyers. Okay, this is a loan thing. Remember, the sweet spot from a lender's perspective on a loan is 20% down, right? We know that. Do we have to have 20% down? Of course not, but lenders love 20% down. If you've got a buyer who's coming in with 20% down, and the seller is crediting back to the buyer an amount in addition or exceeds the buyer's actual closing costs, then the buyer's actually pocketing money. So it's really not 20% down anymore. It's 19 point something percent down. And that's going to cause a problem with the loan. So paragraph E says is that if the seller is crediting too much back, it will be refunded to the seller. No reduction in purchase price. Buyer needs to come in with their whatever down payment is. All right. Moving on, additional financing terms and verification of loan applications. We have a new provision in this contract that the seller and the seller's agent can contact the buyer's lender, not to find out their credit score, not to find out how much money they make, but to verify how the loan is going. So we've got some new provisions in there. And of course, in the top of page 5, the seller is relying on the financing of the buyer. And if the buyer misrepresents the financing, that could be a misrepresentation. And what would I use as an example? If the buyer is saying they're going to get a conventional loan and they switch over to an FHA or VA, I view that as an intentional misrepresentation, and that may be actionable by the seller. So please watch out for that. Okay, so closing and possession. We've already talked about that in paragraph 3. Remember, Property is being sold in its present physical condition, but seller is still required to disclose all known material facts. All right. And again, buyer is strongly encouraged to investigate the property. C deals with issues regarding seller remaining in possession after close of escrow. Okay, so we have some additional language dealing with that SIP and RLAS form, depending on what the seller is going to be in for 29 or fewer days or 30 days or longer. At close of escrow, seller's going to assign all assignable warranty rights, ability to operate locks, keys, systems, that sort of thing, as stated in paragraph 9. And then that takes us to our contingency explanation. And I see I've got something in the chat, but I really want to talk about this a little bit since it's fresh in everybody's mind. Remember back in paragraph 3L, see where it says 8A loans 1? And it says paragraph 3L1. Supposedly, if you hover over that paragraph with your cursor, it's going to take you back to paragraph 3L1. If you click on it, it will actually take you there. Okay, so it's supposed to work both ways, both coming from paragraph 3 into paragraph 8 or whatever, but it can also take you from paragraph 8 back into paragraph 3. At least that's the way it's supposed to work. We'll see how it does. One of them is supposed to be available in mid-December, maybe both of them. Okay, so this should be kind of fun to do our own little beta testing when this contract is released into zip forms. But I want to look at and show you the organization here. Loan, appraisal, investigation of property, review of seller's documents, title. It's in the same order as it is in paragraph 3L. So it's consistent. And that's one of the things I do like about this new form. I mean, I'll tell you the truth. When I first saw it, that grid bothered me in paragraph 3. But it has been, the contract has been reformatted and reorganized. I always got the impression that CAR was just kind of adding stuff with every new edition of the form, and it got a little disorganized. But they reformatted it here, and it seems to make a lot more sense. So I really do like that. And then moving on in paragraph 8, we have the disclosure on condominium plan development, buyer review of leased lien items like hero and PACE loans, removal of contingencies with offer, the warning to the buyer not to do that, removal of contingency or cancellation, and J, sale of buyer's property. Per paragraph 3L8, the COP form will be included. So all your boxes to check, okay, are going to be found back in paragraph 3. The rest of the contract simply explains the obligations, rights of the parties, and further explanation of the meaning of the boxes being checked in paragraph 3. All right. Well, let's go into the chat and see what we got. All right. Okay. Are we allowed to still add seller to contribute to reoccurring and non-reoccurring to maximize seller's contribution? Yes, you can go back into paragraph 3 where it has the loan and specify how much the seller will pay for. But you do have to specify an amount. Some of you will remember the removal of asking seller to pay for termite work, what many people call a termite clearance, even though technically there is no such thing as a termite clearance. It's a certification of completion of work, all right? The problem here is asking someone to pay for something and you don't know what it's going to cost creates a one-sided contract. It's like an agreement to agree, and that's going to cause problems. So CAR insists in this agreement that if you're going to ask a party to pay for something, you need to put the specific amount unless it's an inspection, because most inspections are what? Either free or $100 or less or something like that, right? NHD, what about $110, $125? It's been a while since I bought an NHD policy, but that's kind of where we are, all right? Let's see. Can buyers use addendum to inform sellers of the loan type changes from conventional to FHA VA? Okay, this offer needs to specify how you're going on the loan. And the offer specifies a conventional loan, fixed rate. If you want to go conventional adjustable rate, you need to check the box. If you want to go with FHA or VA, you need to check the box. I think if you're going with CalVet, you check the VA box. Haven't heard on that one yet, but specify in other terms, CalVet loan, if you're doing a CalVet, all right? Once the agreement has now been signed by the seller and buyer, so you've got a contract between the parties, if the buyer at that point wants to go with an FHA or VA, you need to get seller's permission, and seller may be upset and may threaten legal action because unbeknownst to you, they might have had a conventional offer out there with a conventional loan, or they might have had an all cash buyer, but they went with your offer because it was more, not realizing they were going to have to do a government. Okay. So again, you need to be truthful in your offer to the seller. If you're not, that could be viewed as a misrepresentation and that could be actionable. All right. All right. So moving on, paragraph 9, these are items included and excluded. Now, you're going to see a lot more information here because we have smart houses. So it's not just the awnings, the window shutters, the curtains, the light fixtures, the pool equipment. It's also including light bulbs and smart light bulbs. You know, the light bulbs where you clap and they turn on or they turn off, where you can tell them because they've hooked up to your Alexa app, right? Also, you can turn on the stuff in your house with your phone. Now, your phone is your property. You're not selling your phone, but it's not actually your phone that's doing the stuff in the house. It's the app that's up in the cloud. So you get to keep your cell phone, but the access to that app in the cloud, that is now being described as real property. And that ability to go into the cloud and operate your home remotely is being transferred to the buyer. Okay. So the cloud is now part of our real property definition because it's in the agreement, and the seller is agreeing to provide that access or transfer that access over. So they're essentially deleting the app from their phone and giving the buyer the ability to accept that app on their phone. Okay. Now, I'm an idiot when it comes to tech. Okay. So don't ask me how all this works, but smart people, smarter than I am, know how to work this tech stuff. But conceptually, that's what's happening here. And again, this thing is moving, right? We are in new technology and expect new things coming out as we progress. As I mentioned before, paragraph 6, leased and liened items. Those are those hero or PACE loan financed doodahs or things like solar panel heaters or solar panels on the house. Okay. And then C, things to be excluded from the sale. Okay. Again, we list the items back in 3P1 and 3P2. Here, we're just explaining in greater detail exactly what those items are. All right. The negotiated items are found in 3P1 and 3P2. whereas the standard stock items that typically transfer over are explained here in 9B and 9C. All right. Now we go to page 7. Paragraph 10 is our allocation of costs. Okay. Now again, the costs have been allocated in paragraph 3. Here we're just explaining what those items are. Okay. So inspection reports and certificates, government required and corrective remedial actions, point of sale requirements, if any. Remember I talked about reinspection fees. If the seller was supposed to do something and they don't do it, and now the property needs to be reinspected, seller's going to get a bill for that, and seller's agreeing to pay for that. So it's really important, particularly with smoke alarms, carbon monoxide detectors, and water heater bracing, sellers need to get that done no later than 7 days after acceptance. My recommendation for those of you who have listings, tell your seller to do it now. Okay, just save everybody a lot of headache and a lot of hurt feelings and arguments and fights. Just do it now. It doesn't cost that much. When you look at the price of a property in this area, you're talking about like little. And then explanation of a home warranty, they're down on C. All right, so let's see what we have in the chat. Is a ring at the front door automatically included or excluded? It's included. It's attached, and the software is part of it. So my interpretation is that ring doorbell or that ring alarm thing, those things are going to be included. Okay. When must you use the new RPA? Sometime in the middle of December. CAR is going to release this version. Okay. When they release this version, the old version automatically goes away. You will not have both contracts in zip form at the same time. One will disappear, the other one will appear. And it'll happen presumably at midnight. And we won't know it's here until somebody early in the morning opens it up and sees it and lets all of us know. Okay. I'm imagining CAR will probably send out a mass email. It will probably go to your association executive officers. Laura will probably get an email from CAR. She will in turn be able to disseminate it to all members. I'm hoping that's going to happen from CAR, but CAR has changed forms before and not told anybody about it. And I actually got caught once. I was actually giving a presentation and I was looking for something in the contract and it was gone. They changed it and didn't tell anybody. Okay, but no, this is a big enough change. I think CAR is going to let everybody know when they flip the switch, and they probably will let you know a little bit in advance. Okay, whenever they make the switch, you need to start using the new contract. Please don't go back and try to use an old version. Okay, make the switch, move to the new contract. Where would we note for seller to cover termite inspection and repairs? You don't. Asking the seller to do repairs when you don't know how much there's going to be is going to cause you problems. Okay, and it could get you sued, because invariably you're going to tell the seller, or someone's going to tell the seller, oh no, it doesn't cost that much. It's only like $3,000. I've actually seen 2 termite repair bills. One was $38,000. Another one was $42,000. Okay, subterranean termites that had attacked the load-bearing walls. So you need to handle termite repairs as a request for repairs. In terms of who's going to do the inspection, you can put that back where it called for other inspections in paragraph 3. But since most termite companies don't charge for an inspection, what I recommend that you do is go ahead and have it inspected. When the buyer gets the report, do it as a request for repairs and include a copy of that inspection. Now the seller is faced with the dilemma. If they don't agree to do the repairs, the buyer can cancel, which means seller has to go back on the market. If they go back on the market, they're going to have to disclose this termite inspection so that the next buyer who makes an offer is going to ask them to do the repairs again. And all they're going to do is lose time. So seller, do the repairs now rather than lose this transaction, go back on the market, get another offer, go into escrow, and then get hit with another request for repairs, right? I mean, that's how it's going to work. So, and the seller has no choice than to give buyer two a copy of the report, because the copy of the report is up in Sacramento at the Structural Pest Control Board. The buyer buys the property and discovers that it has termites and the seller didn't disclose it. The buyer's going to sue the seller for everything. That's fraud. And the seller's agent and the seller's agent broker. I mean, it's horrendous. So best way to deal with it is a request for repairs. Can you require a seller to install a new smoke CO2 if it is expired or is too old? It needs to be operative, okay? If the device doesn't work, then it needs to be replaced, okay? But if it's just old, no, as long as it's still functional, okay? That's the key. It needs to be functional. Expect the appraiser or the home inspector to test it and make sure it's operational. But if it's not operational, then the seller is not in compliance with the law, because all owners must have operable smoke alarms, CO2 detectors, and water heater bracing. It's like, well, what if the water heater is not braced properly? Well, no, it needs to be braced properly. I mean, if it still falls down in an earthquake, what good has that jerry-rigged bracing done? If a termite report is disclosed up front and we want seller to pay for the repairs, is it acceptable to say seller to pay for all section 1 work, or does it have to say seller to pay for X amount of repairs as cited on the report? I would go with the latter, but you are going against CAR recommendation, and make sure you involve your broker in this. And if you're going to be making that extensive of a modification of the offer, you might want to seek legal advice. You might want to enlist the services of an attorney. I mean, it's that big, okay? Again, you don't want to be making significant modifications or changes to the contract. All right, moving on. Got about another hour to go. We're going to get through this. So paragraph 11 are our statutory rights. Again, remember, even if you release contingencies, you still have your statutory cancellation rights for TDS, NHD, and other type of disclosures, okay? So again, removal of contingencies with the offer will not alleviate or prevent the seller from canceling when they receive these disclosures, all right? Same thing with lead disclosures down at the bottom, right? For properties built prior to 1978. Going into paragraph 8. So C, home fire hardening disclosure advisory. So this is a new form that's come out. If, and it's 3 items, okay? If the property was built prior to 2010, that's number 1. And if the seller has to give a transfer disclosure statement, that's number 2. And if the property is identified in the NHD report as being in a high, excuse me, or very high fire hazard severity zone, then the seller must give the FHDS form, excuse me, specified in paragraph C here, 11C. So if that doesn't apply, you are not required to give, or the seller is not required to give, an FHDS form, home fire hardening disclosure and advisory. If you are in those three areas, all three, those three kinds, then you are required to give it. All right. Now, talk to your broker. If you are not covered under this, which means you don't have to give it, I think giving that form sometimes creates more confusion than it's worth because it calls out local inspections. And many of our localities don't have local inspections, and it gets very confusing for the parties. I kind of like that wildfire disclosure form I talked about earlier. You can give that on all properties regardless. It's simply a disclosure that this house may be an area that's prone to fire. Okay. This form here is mandated if those three conditions exist. Property was built prior to 2010. The seller has to give a TDS, and the NHD report says it's in a high or very high fire hazard zone. Okay, so all three have to exist to require this form. Okay, the defensible space disclosure addendum is continued there on in D, explaining it. E, as I mentioned before, you cannot waive your statutory disclosures. So release of contingencies do not waive these disclosures. And you have termination rights depending on whether you're given the property, or excuse me, given the property, or giving the disclosure in person, 3 days, given the disclosure by mail, 5 days. Okay, and that would include email. Withholding taxes. We all know this as FERPTA, right? So the paragraph has been changed. The paragraph now says the buyer or qualified substitute will make the withholding. So the withholding will be made unless the seller provides the AS form, which you know as the FERPTA form, to the buyer or the qualified substitute. Then a withholding does not have to be done. Okay, so the contract says the withholding will be done. What does that mean? Well, for federal, 15% will be withheld and paid to the IRS. If a withholding did not have to be made, then the seller / taxpayer will get it back as a refund when they file their taxes. If you don't want that withholding to be made, then the seller must present that AS form to the buyer or to escrow if escrow agrees to act as a qualified substitute. Independent escrow companies, title insurance companies, banks, okay, all typically are willing to act as a qualified substitute. Who cannot act as a qualified substitute? Broker-owned escrows. You see, broker-owned escrows operating under a real estate broker's license is unique to California. So there is no exception created under federal law. The only exception created under federal law is escrow companies, title insurance companies, bank-owned escrows. Okay, so that can be a problem. All right, so just FYI on that. Our Megan's Law disclosure and our disclosure of the website for gas hazardous liquid transmission lines are listed for it, so you don't have to provide an additional disclosure there. If you're in a condominium, again, that has to be disclosed by the seller within 7 days. Okay. Seller will request copies of all HOA documents within 3 days of acceptance. The thinking is they request it within 3 days. Okay. Hopefully the association will get it to the buyer within 10 days from acceptance. Okay. But seller must notify the buyer that you are in a condominium or planned development within 7 days. So seller must request documents in 3 days from the HOA. Seller must disclose to the buyer that you are in an HOA, okay, plan development, condominium. Okay. Typically, you do that on the SPQ form. And then hopefully the association will get those documents to the buyer within 10 days. Say again, we can't require the HOA to do it. I believe the statute says they're supposed to respond with documentation within 10 days, but the HOA is not a party to this agreement, so we can't require them to do anything, okay? We can only require to make the request as early as possible, okay? And again, down at the bottom, seller's required to disclose all known material facts, anything that possibly could affect the value of the property. Buyer also has an obligation to investigate the property, and that is explained on paragraph 12. Buyer agrees that if they do any damage to the property during their investigation, they are responsible and they will indemnify the seller for anything caused by them and or their inspectors or their investigators, okay? Under 12B, we do have some limitations for termite inspections. Certain areas they will not go into. Essentially, we do not want the termite inspection to cause any structural damage or lasting damage to the property, all right? But again, if you're using a reputable termite company with a reputable inspector, shouldn't have a problem there. Title investing, again, that's something between the buyer and escrow. So the buyer is going to notify escrow how to take title. You never want to advise the buyer on how to take title. You don't want to share how you hold title to property because that could be viewed as the unlicensed practice of law. The buyer may have to provide additional documentation to the title company on their identity and where they got the money. You'll notice there under 13E, the geographic targeting order issued by the Financial Crimes Enforcement Network. And I believe LA County is still in this order. What does this have to do with? Money laundering. There have been cases where organized crime has decided to launder their money through the purchase of real estate. So when funds are coming in, title companies will try to ascertain who the person is, where the money is coming from, et cetera, et cetera. That's under this GTO or geographic targeting order. And they may be requesting additional information from the buyer in order to cover this order. Buyers agreeing to cooperate with this, okay? And again, don't want to make a federal case out of it, but it is a federal case. It's kind of like FERPTA. We have no choice. Congress has spoken and we must obey, all right? Moving on to the dreaded paragraph 14. And I say that somewhat tongue-in-cheek because paragraph 14 has been with us for now over 10 years. I think everybody is pretty comfortable with it. So what I'm going to do here is I'm just going to make an overview. If you do have specific questions, please put those into the chat. I will answer them. Also, if you came in late or left, I'm going to hang around here after the end of this class. Laura will probably turn off the recording, or she can leave it on if she wants to. And I will take all questions, okay? Just remember, I'm not giving legal advice, just a teacher, right? Okay, so the seller is going to give everything they got, all their disclosures, all their reports, everything to the buyer within 7 days after acceptance. The buyer is going to have 17 days to do all of their investigations and inspections. Again, 17 days after acceptance. So we got the 7 days and the 17 days concurrently. So provided the seller has given everything to the buyer within those 7 days, the buyer's going to at least have 10 days to digest that and do whatever additional inspections they think is appropriate. As a result of their inspections, they may decide that they need the seller or they want the sellers to make some repairs. So they can give that request for repairs to the seller. The seller can agree, disagree, ignore, or not respond. I mean, but it's up to the buyer and seller now to have a little negotiation, right? And if the buyer doesn't want to buy the property based on something they learned or discovered via their investigation or inspection, and they want to back out, they can back out. But it has to relate to their investigation. If the buyer has put another property in escrow and they're going to decide on which one to buy, and they do, and they try to cancel this one, and they're canceling this one because they just like the other property better, that's bad faith. If that's ever found out about by the seller could have cause of action against the buyer for breach of bad faith, or breach of good faith, which is bad faith, okay? So the reason the buyer is canceling has to relate from what they learned during their investigation. Now, could it be that the buyer has just decided, you know, I just don't like the way this house faces. I don't want morning sun coming in my bedroom or kitchen, or I don't want setting sun coming in my living room, or whatever, no matter what it is. But if that is the reason, can they cancel for that? Of course they can, okay? They can do it within that first 17 days. Now, if they don't release their contingencies on or before the 17th day, contingencies continue to run. What's the seller to do? The seller can give a notice to buyer to perform. Say 2-day notice, and they can give it 2 days early, which would be the 15th day. And after those 2 days that the seller gave that notice to buyer to perform, then the seller can cancel. But they don't have to cancel. But they can't cancel unless they first give that notice to buyer to perform. All right. So that's how it all works. Now, questions come up because it's found in this paragraph about what happens if we get to the end of the escrow. Okay, so the buyer's already released their contingencies. Right? We're now at the end of the escrow, and nothing's happening. Loan doesn't fund. And the seller says, what the heck's going on? Escrow, cancel. You have to give a demand to cancel escrow to the buyer, and that's a 3-day notice. In other words, we want to give the buyer 3 more days to try to get their act together. So we have this demand to close escrow, not cancel escrow, demand to close escrow. But that's a 3-day notice. But that's at the end of the transaction. Okay, that doesn't have anything to do with removal of contingencies. That's at the end of the escrow. We're at the closing date, and for whatever reason, the buyer's not performing. Before the seller can cancel, they got to give this demand to close escrow to the buyer. All right. And there it is under G, demand to close escrow. I was a little premature in my explanation, but it's housed in paragraph 14. So sometimes agents confuse the demand to close escrow with the notice to buyer to perform. They're completely different. I wish CAR would have put this in a different paragraph, but they didn't. It's in here, and sometimes it gets confused. All right. So effective cancellation on deposits. Again, we look to liquidated damages clause. Okay. If a party in bad faith refuses to release a deposit or demands, but anyway, there is up to $1,000 civil penalty for refusing to release a deposit that should be released if the parties are operating in good faith. And that's in bold print there. All right. Paragraph 15, any repairs that the seller agrees to do, okay, will be done in a workmanlike manner, and paid invoices will be given to the buyer. So the buyer knows not only were they done, but they were also paid for. Paragraph 16, our final verification of condition. That's the final walkthrough 5 days before close of escrow already talked about that. Paragraph 17, prorations, rents, property taxes, sometimes insurance and interest. Basically, the expenses and income on the property will be allocated based on close of escrow. So if I'm selling you an apartment building and escrow closes on the 15th, it's safe to say I've probably collected all the rents by the 15th. Well, what you pay me for that apartment building will be reduced by the equivalent of a half a month's rent. That's a proration, right? So paragraph 18, we refer or reference another agreement that handles the compensation between brokers. Remember, broker compensation, your agent's compensation, is not addressed in this agreement. I know some agents will, when making an offer on a for sale by owner, put their commission in this agreement. Bad idea. First of all, you're not a party to this agreement, so it's not enforceable. But secondly, the statute of fraud says any commission agreements in a single family dwelling, you must have a disclosure in 10-point bold type or in red print, not fixed by law and are negotiable. And that doesn't exist here. So it would violate the statute of fraud. So again, if you're writing an offer on a for sale by owner, you need to use the SP form, Sam Paul, single party compensation agreement. Establish your commission with the seller with that document. Does not create agency in, and then you can write your offer. All right. Paragraph 19 lets escrow know what paragraphs in this contract they need to be concerned with. And goes on. Paragraph 20, selection of service providers, escrow, title, home warranty, etc. Okay, that's a decision by the parties. We provide recommendations and advice, but we do not determine. And again, do not push your third-party provider onto other parties, because that could be viewed as a RESPA violation. Why are you so insistent on this escrow company, or this home warranty company, or this title company, unless they're compensating you for that referral? That's called a kickback. That's illegal under RESPA, so be careful there, okay? We can certainly advise, and if there's a company out there that provides poor service, we can certainly warn, but it needs to be their decision, not our decision, all right? We will report this sale to the MLS, okay? So parties, I know that's always been kind of an issue, don't want that reported to the MLS. Some people say, no, it's going to go into the MLS because the MLS rules require it, right? So we don't really have a choice there. Paragraph 22, the prevailing party, the winner, is entitled to attorney's fees, provided they agree to mediate the dispute. Okay, we'll talk about mediation in a little bit. And then paragraph 23 is our assignment paragraph. Remember where I said, if the buyer is just assigning their position to an alter ego, that's okay. You know, seller can't deny that. But if they're assigning it to a third party, they need to notify and request seller consent within 17 days from acceptance. If they're being paid by the other party, they have to disclose that to the seller. If they fail to request that within 17 days, okay, the seller is under no obligation to approve the assignment, okay? So again, you got to keep it within that 17 days. Paragraph 24 is our commitment to fair housing. And then paragraph 25 gets into the definitions. And there are a few definitions I want to talk about. But let's go up here to the chat, because I got a chat that just came in. Sell and buy property at email. Okay, this is my email. Can you send me the handout? No, you have to email me, because I mean, I'm not even an independent contractor. I'm a nobody, okay? I am simply an affiliate member of this association, and Laura controls everything. So if you need something, please email me. My email address is the very beginning of the chat. At the end of this PowerPoint, you will see my email address and my school phone number. So you need to send me. I'm not following stuff in the chat. I already said the chat.
I'll
Laura
send
controls.
him the
Okay.
handouts.
Laura controls everything here. Okay. And if she wants to cut me off like that, she can mute me. Okay. So I'm just hanging out talking about the forms. All right. So let's go into some definitions that I think are important because there have been a few changes. Okay. We're doing really well on time, by the way. I'm getting this form down finally. Okay, so they're being real loose with this concept of CAR form. It's the CAR form or any form that looks like the CAR form. Up in the Bay Area, they have a competing publisher who produces a similar form that looks like the CAR form, but it's not CAR. So I think that's what they're addressing there. Counting days. Nothing causes more confusion in our lives than counting days. So this is how we count days, okay? Unless it's the deposit, then it is 3 business days. Why 3 business days? Because escrow, banks, whatever, they're not open on non-business days, right? So a business day is a day that escrow is open. If the county recorder's office is closed, title is typically closed and escrow is closed, right? Because escrow doesn't open unless county recorder's office is open and banks have to be open. They all have to be open at the same time. So we are talking business days with the deposit. Everything else is calendar days. Today is day 0, okay? Tomorrow is always day 1. So whenever something happens, tomorrow is always day 1. It doesn't matter if it's 8 o'clock in the morning or 5 o'clock in the evening. Tomorrow is always day 1, right? It's the first thing. Then we count our calendar days. Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, Monday, Tuesday, Wednesday, all the way through until the 2nd day, the 3rd day, the 5th day, the 7th day, the 17th day, right? Those are all our days. If one of those days, the 7th day, the 17th day, whatever, falls on a Saturday, Sunday, or holiday, we roll over to the next business day. Because if you are in contract with, say, a corporation, they might not be open on a Saturday, Sunday, or holiday. So we want to roll it over to the next business day, okay? Likewise, if you're talking about days after escrow, okay, COE plus 3, okay, or 29 days for the SIP, or 30 days for the RLAS, the close of escrow day is also day 0, and the next day is day 1, okay? So we always count tomorrow as day 1. Right. Now, the next thing is we've got scheduled performance days and allowable performance day, okay? So if the 17th day is a Saturday, that's the scheduled performance day. But because it's a Saturday, it rolls over to the next business day, which is presumably Monday. So Monday would be the allowable performance day, okay? However, when can you give that 2-day notice to perform? Is it on Saturday, 2 days before the allowable performance day, or on Thursday, 2 days before the scheduled performance day? Thursday, before the scheduled performance day. Okay, so we always go with the day number, the 17th day, the 5th day, whatever. But if it rolls over, it just extended time. Okay, but you can give the notices 2 days prior to the scheduled performance day. You don't have to try to calculate the allowable performance day. Okay, I think I got that right. Okay, hopefully I got that right. All right, but you can read paragraph 25I and catch me if I made a mistake. Okay, but basically we follow the scheduled performance day, even though they don't actually perform until the allowable performance day. All right. Deliver, delivery, and delivery. Okay, so we got something new at the end of this contract. So we're saving the best for last. agents are asked to put their email addresses next to their signature. And when they do that, you can give notice to their client by emailing them. And if you email them, then delivery has been performed. Well, what if they didn't pick up their email? It doesn't matter. You're supposed to, okay? So if I'm the agent in the transaction and you want to send me something for my buyer or my seller, all you have to do is email it to me. Now you can email it either in an attachment or by a link. What if I don't like links? Well, if I don't like links, I have 3 days to send it back to you and say, hey, I don't like links, or I can't open your link, or links stink. And then you have to send it to me as an attachment. But if you send it to me as an attachment, okay, you've got proof that you emailed it to me at this address, which is the same as it is on the last page. And that's proof enough. But I didn't open my email. Tough. We're in the real estate business. We're supposed to open our emails. Welcome to the 21st century, right? Okay, so that's the new rule. That's talked about here in the definitions, and we're going to talk about it later when we get to the last page. All right. Pretty much done here. Paragraph 26, no real change. Any changes, okay, to this need to be done in writing, okay, along with paragraph 27. This is the entire agreement. No changes to this agreement unless done in writing, signed by all parties. And we do have the ability to identify entity signers on the last page, so we don't have to use that representative capacity form anymore. Unless you've got multiple entities selling the property, then it becomes like a signature addendum. Okay, we'll talk about that in a little bit. Okay, so this is really cool. I really like what they've done with paragraph 14, because a lot of people think that mediation and arbitration are the same and together. They're not. Mediation is sitting down with a mediator and the other side to try to reach a compromise. If you do settle, it's over. If you don't settle, then you can litigate or arbitrate or whatever you're going to do. Dueling, if you want, I guess. I guess there are some jurisdictions that still allow dueling. But anyway, that's mediation. And anybody can be a mediator. Anybody can, okay? It can be your parish priest. It can be your bartender. It can be your masseuse. Whoever the two parties agree upon can serve as the mediator, okay? However, arbitration to include must be initial, because with arbitration, you are giving up your right to a trial, which is a fundamental constitutional right. And that arbitrator will not only make the decision, okay, but their decision is typically not appealable. You cannot appeal it, all right? Now, the arbitrator does have to be either a retired judge or an attorney with 5 years of residential real estate experience. Put in the name of the arbitration company or arbitrator in here. CAR is actually talking about having a drop-down menu with arbitration services like American Arbitration Associations, JAMS, Judicial Arbitration Mediation Services, things of that nature. They're still trying to work that out, but that may be something to come, okay? But remember, arbitration has to be elected in. Both parties must initial to have it included. If one party initials and the other party doesn't, then you need to either counter it out or you will not have a contract, okay? If you have a contract with only one party's initials on arbitration or liquidated damages, you don't have a valid contract. The entire contract fails because you do not have a meeting of the minds. But look at the way they formatted this page. It's very clear that both liquidated damages and arbitration is special because they're boxed in and they require initials to be included from both sides. Mediation is not boxed in and does not contain an initial portion. So mediation is a mandatory required part of the contract. And if you decline to mediate, you give up your right to attorney's fees if you win your case. All right. So liquidated damages. Okay. If the buyer defaults after releasing contingencies and has initial this clause along with the seller's entitled to keep the deposit as damages. Okay. But along the same lines, the seller cannot sue the buyer for anything else. So it's kind of a limitation of liability for the buyer as well. All right. Now, if the buyer intends to live in the property and the deposit is more than 3% of the purchase price, then the amount the seller can keep is capped at 3% of the purchase price. But remember, that does not mean that the seller gets to keep 3% of the purchase price. No, it's the deposit, but never to exceed 3% of the purchase price if buyer intends to occupy the property as their residence. All right. If it's not intended to be occupied as their primary residence, then it's the entire deposit, regardless of how much it is. All right. So I think I've explained liquidated damages now. Remember, it's not a non-refundable deposit. Please don't use those words. They're bad words, okay, in residential transactions. We've explained mediation, and I've explained arbitration. And now we go to the page 15. Again, expiration of offer, 3 days, already discussed in paragraph 3. If we have an entity buyer, you check the box in B. You then identify the name of the entity and who the signer is, all right? And now the signer can just sign their name on all disclosures and all of their documents. They don't have to reference the entity. So let's say I am the managing member of the Mount SAC LLC. So the Mount SAC LLC is the buyer. So the name of the buyer, the printed name of the buyer is the Mount SAC LLC. It is signed by me. So my signature would be there on the top line under D. And then the printed name would be Edwin Estes. And the title would be manager, right? But once I do that here or below, once the seller does it there, okay, then I can just sign my name on future documents. I don't have to keep going back and saying Mount SAC LLC by Edwin Estes, manager, right? I can just sign my name, okay? So hopefully that will make it easier in our transactions and keep us on the right side of the law, okay? So I think we're good there. If you have more than 2 signatures, you can always use the additional signature addendum. Just like if you have more than 2 entities, it's the Mount SAC LLC, the Chafee College LLC, and the Citrus College LLC. Well, then we would have to use a representative capacity signature addendum because we have more entities. We don't have enough lines here, okay? But hopefully this will take care of everything. All right. If the offer is not accepted, it's always nice to have the seller initial. They didn't accept the offer. No, particularly if you're in a multiple offer situation. Remember that agent whose offer didn't get accepted, you're going to have future transactions with them. You want to let them know that your seller did see their offer, thought it stank, and rejected it. Actually, I like to go one step further. I actually like to invite them to come meet with the seller and myself, present their offer to the seller, and then leave. And now if the seller rejects their offer, they can have no issue with me because I gave them their best shot. The sellers thought their offer stank, but hey, they presented the offer. It's not on me. So I know we've gotten away from direct presentations. When I got my license, we used to do direct presentations all the time. But then fax machines came around and then the internet was developed. Now we don't do them anymore, right? But you can still do a direct presentation. If you've got a multiple offer situation on your listing, particularly if one of those offers is coming from somebody inside your office, I strongly recommend you consider inviting them to make a direct presentation. If they refuse, okay, fine. But having the seller initial not accepted is always a nice thing. Is it required? No. But I think it will help you in your future business. All right. So now we go to the real estate broker section and we identify the buyer's brokerage firm, the seller's brokerage firm, all right? And then notice under both 5A and 5B, designated electronic delivery addressees or addresses. Okay, addressees, how do we want to pronounce it? Okay, so you put your email down there. That allows the other side to deliver notices, documents, disclosures, everything to you, and it is deemed received when it is emailed to you. All right. Now, alternative, who could that be? Well, it could be somebody else in your office. It could be, I wouldn't recommend using the seller or the buyer because I don't like them really getting directly involved, but it could be your transaction coordinator, right? If your transaction coordinator is collecting documents, then you could use that, and then you can check the box to have the alternative designated delivery being primary, okay? Again, this is CAR's effort to try to improve the delivery of materials, documents, and verify that they came in, all right? And then escrow holder acknowledgement at the bottom, all right? And then finally, you're encouraged to initial that the offer was presented. This is really more if you have a situation where the seller doesn't want to initial that they're rejecting the offer, you can at least initial that you did present it on a certain date. That might be effective with REOs. If you have a listing from a lender on a foreclosure and you want to let the other side know that you did present it and you're still waiting, all right? Nothing's happened yet, okay? You might want to use that. So at this point, I have gone through the form and I don't have anything in the chat, which really surprises me. Oh, here they come. Okay, I knew it. Okay, if a request I want to present my offer, does the listing agent have to agree? If not, does he have to send me something in writing from the seller stating that the seller does not want me to present my offer? Okay, so this is actually addressed in your RMLS rules. I don't have a copy of those rules in front of me, but I believe the rules state that if you request to do a direct presentation, the seller may deny that, but you can ask for written verification from the seller that they do not want to have you do a direct presentation. So check your CRMLS rules. Some of you may not be a member of CRMLS, whatever MLS you're in, but I believe under the model MLS rules, they do require direct presentation unless the seller has stated they do not want that, okay? But again, for you listing agents that don't like it, you're going to curry favor with the other agent. And at some time in the future, you're going to have an offer on one of their listings, or you're going to have an offer on a listing by somebody else in their office. And the better relationship you have with the other side, with those other agents, it's going to help you in your business. Trust me on this. I've been in this for over 4 decades. Okay, I am that old. See, no hair. All right. What can we do if the listing agent does not respond to phone calls, texts, or emails on the offer status? I recommend calling their broker or their manager. Okay, that's probably the best way. You might want to talk to your broker first. Your broker may actually know their broker, which is great. But if you can't get a hold of the agent, you really do have a fiduciary obligation to your buyer to see what's going on. So I would give them a half a day. And if you don't get anything, I'd reach out to their broker or manager and say, look, I've got an offer. I have not heard anything back from their agent. I'd like to know what's going on. Can you assist me? And it could be that that agent is just busy with something. I mean, they just haven't had a chance to get back to you. But I think we all have an app on our cell phones that we can check our email. And there really isn't anything as pressing as a pending offer, particularly in a market where you do have the chance of multiple offers. All right. What else do we have out there? Anything? Laura, this is strangely silent. And I finished 15 minutes early. Well, my email is here. So is my telephone, but it's better to email me than to telephone because I can check my email everywhere. Like I said, I'm not giving legal or tax advice, but happy to talk about forms. How can you access the recording? I understand Laura is going to put it on the association website within the next couple of days. When you record a webinar, it does take a while for that entity, I think we're using Zoom here, to get it back to you. So you need to get it back to her, and then she needs to post it. So give her a couple of days, but it should be there relatively soon. And you can watch the reruns to your heart's content. Content is the word I'm looking for. You know, after almost 3 hours of talking, I'm kind of worn out. So any other questions? Don't see anything. Oh, no more chats. Lots of chats. Seem to be all thank yous. And I appreciate your thank yous. Now's a great time to send thank yous because I've answered all the questions. So I'm not kind of searching for them. But I'm glad you enjoyed the class. We're actually going to do this class again in November and December live.
Yeah, we have it scheduled for November 3rd.
November 3rd and December, what's our December date?
December is
17th, maybe? No, 1st.
Yeah, December
1st. Okay, yeah. So if you want to jump in and ask more questions and watch me live again, you can, or you can just watch the reruns again. And I think with the reruns, you can kind of fast forward. So you can kind of scroll that cursor down below and move over. And since I'm using the forms in my PowerPoint, you can go to that form that you want to learn more about or want to revisit, something like that. So, you know, please share with everybody in the association. We're just trying to get the word out there. It is a big change and it's going to take some getting used to, but I think hopefully you're a little bit more comfortable with it after you had a chance to work it a little bit. I think you're going to like the new form. I think it's going to be a lot easier to work with. Certainly it's going to be easier to explain because all the negotiating items are in those 3 pages. All right, great. Okay, Laura, you want to kick me out?
Yeah, we're ready. So I know a lot of people have been asking about the recording and it will be on the website within a couple of days. It's on the education page of the website, the Tri-County's website. And that's where all the recordings of the classes are. So you should be able to find it there. And that's about it. We'll see you again November 4th, right? Is that what we said? No.
November 3rd, I think it is.
November 3rd. Yep.
Yeah, on the other side. It's on the other side of my office. I can barely read it, but yes, you'll be here and you'll be sending out newsletters and
yeah,
all kind of good stuff. So
yep.
We're good.
Okay. See everyone.
Okay.
Bye.
Thank you. Bye-bye.